वैशाली का
And Samir is not going to join us today, right?
right.
So you're going to do it, opening remarks. Good morning. Good morning, everyone. So it's a pleasant Sunday morning, and definitely one of my favorite topics, accounting standard for we are going to discuss a lot about this. So without wasting much of time, I welcome. Do we wait for Gadia sir to join in? So he's expected to.
I will call him.
Yeah.
I will call him.
So we are expected to have CA Manish Gadia, Chairman WRC of ICAI. Now we have Speaker of the Day, CA Chintan Patel, Chairman Indian and AS Accounting Standard, and IFRS Committee of WRC of ICAI. Then we have CA Kashinath Patel, Vice Chairman and Secretary, Pune ICAI. We have our favorite Chitare sir, for whom like no introduction is needed. So I welcome all of you to this wonderful morning. And then I would ask CA Kashinath Patel to have the welcome address, please.
Good morning, all of you. Respected Chitare sir, our own Central Council member, our today's Speaker, Regional Council members, Chintan Patel, our today's MOCCA, Saile Kothari, and all my beloved members. I welcome all of you on behalf of Pune branch of WRC. In spite of Sunday morning, thanks for joining all of us. Thank you.
Nice. Thank you, Kashinath. Now, I may request to our beloved Chitare sir to have, share with us few words.
Yeah, thank you, Saili. It's also my pleasure to join and welcome one and all for this particular webinar. And we are really glad that expert in the subject, CA Chintan Patel, has agreed to join, and he would be enlightening us on the topic relating to accounting standards applicable to MSME enterprises, or rather, all accounting standards are applicable to each accounting for accounting of every entity, but considering certain difficulties faced by MSME, certain concessions are given, and those concessions really we have to understand. At times when people discuss, particularly in small towns or other places, and they feel that this accounting standards is an unnecessary imposition on the profession by ICAI, because they at times are complicated. One will have to study those accounting standards. There are changes. So can't we spare these small entities, micro entities from following accounting standards? And perhaps it may be a legitimate thought if you look at from their perspective. But let us also consider the another side of the coin. Now take example of GST audit. Now initially, when the GST started, maybe chartered accountants were not in the field of indirect taxes to that extent. Service tax some were doing. But after advent of GST, I think almost all professionals, particularly in non-metro cities, have embraced this GST practice, and they are doing it. And today, maybe out of practitioners who are practicing GST, maybe 70–80% are chartered accountants. From inception, we were doing audit of GST also. But the Finance Act 2021, the finance minister announced that there is no need of GST audit. And what is the reason? And if you analyze the reason is whatever information is required for GST, maybe tax payable, maybe credit that you are entitled to. Now, if everything is provided by the machine and those figures are churned out by GST department itself, then where is need of audit? That was one thought process. And the industry represented about cost aspect of this GST audit. Of course, that is not correct. On some other occasion, we can really consider why it is not correct. But if you look at now accounting, coming back to our topic for the day, If you spare these all entities to whom accounting standards are not mandatory from compliance with accounting standards, then what will happen? Then tomorrow, almost all accounting software people will canvas that you don't need a chartered accountant to prepare final accounts. Our software itself, you write the accounts, and with each entry, you will get profit and loss statement and you will get balance sheet. So where is need of a professional? I think it is not that with this reason that accounting standards are there. There is another reason also, and that another reason is true and fair view. Now each language needs a grammar. If you want to say that okay, you are not talking correctly, then you should be able to have some rule book in your hand and say that okay, this is the manner in which this language is spoken, and you are not in conformity with that rule book, therefore you are not speaking correctly. Now accounting is also language of financial world, so that also needs to be spoken appropriately, so that the person who is communicating and the person who is receiving communication are on the same page. And this grammar is provided by accounting standards. And ICAI, being an authority created in the year way back in 1949, with a prerogative in the field of accounting, auditing, it has captured this opportunity because who else will develop those accounting standards? And it has started giving accounting standards. In initial period, they were mandatory, but by mandatory, what we mean is mandatory on chartered accountants, because ICAI don't have jurisdiction on persons other than chartered accountants. So it was mandatory for chartered accountants. What do we mean by mandatory for chartered accountants? That if any financial statement you are certifying as true and fair, that financial statement has followed those accounting standards, whether they are mandatory under the parent law governing that entity or otherwise. And going forward, the Companies Act has made it mandatory under law itself. They have had a separate agency now, NAFRA, which coins those accounting standards. So there is a statutory background for those accounting standards. Of course, this process happens in consultation with ICAI. But what about those entities which are not corporate entities, non-corporate entities? So to them, the ICAI accounting standards are mandatory. And by mandatory, what I mean is maybe it is not mandatory to those entities. I'm not saying non-corporate. There may be corporate entities also, like limited liability partnership, cooperative society, or other non-corporate entities like partnership firm, proprietorships, etc. To them, when we say it is mandatory, that if there is non-compliance, a chartered accountant has to point out that non-compliance. And let me tell you at same breath that pointing out non-compliance does not necessarily mean that it is a qualification. It is just an observation, because law does not make them mandatory. But if because of that non-compliance, the accounts are not reflecting to true and fair view, say for example, you have not made provision for bonus or provision for gratuity, in that case, accounts may not reflect true profit, true state of liabilities. So we will have to think of qualifying it. But supposing some disclosure is not made of related parties, etc., perhaps it may not impair true and fair view. It may have limitation over knowledge of the reader. So for the purpose of understanding of stakeholders, these accounting standards are enacted. Now going forward, there was demand from micro, small and medium enterprises that, okay, we are not geared up to comply all these nitty-gritties of accounting standards. And therefore we deliberated at the council that what we should do. And then those entities were spared from certain tedious provisions of accounting standards. On the council table, it was also discussed whether we should have another set of accounting standards for MSMEs. But then it was thought that it will be very tedious to have 3-4 sets, one set by company law, one set by NAFRA, one set for public interest enterprises, by institute, one for other normal entities, one for small entities, income tax department also coming out with ICDS. So it will add to complications. So it was resolved that we will maintain the existing accounting standards, and for micro, small and medium enterprises, we will give certain concessions. And those concessions we will be informed by Chintan Bhai. In fact, as far as any change by ICAI or any other enterprise or government is concerned, it has to be prospective. So if we make some rule today, it should be applicable in realm of finance, maybe from the financial year commencing on 1st April 2022, because this financial year 21-22 has already commenced. However, as far as this MSME guidelines are concerned or standards are concerned, they are made applicable from financial year 2021. And the reason being that for these MSME enterprises, no new rule has been coined, but certain concession has been conferred on them. So it was thought fit that when we are giving concession, why make them wait for 1 year or a period of more than that? So it was made applicable from the financial year 2021. And it would be very, I congratulate Pune branch, Vice Chairman Kashyanath is on board, that you have at an opportune time scheduled this particular webinar, because now as I observe that from Monday onwards in Pune, there is opening up, even malls, restaurants, everything will open up. So surely chartered accountants will also in a big way start their tax audits, other attest function. And ahead of that, they will be informed on this Sunday morning about what rule book they have to follow as far as audit of small and medium enterprises is concerned, on micro enterprises. And I really compliment you that you have requested Chintan Patel to do this job or honors. I had occasion to share a room with Chintan at Mumbai when we attended one international conference. And during the process of discussion, he informed me that how deeply he is involved in the topic of this accounting, corporate laws, etc. So what I could learn from him about accounting, little what I'm speaking now because of that acquaintance. I think if in few hours, Chintan Bhai can enlighten me to talk this much, just I imagine that if he's giving full-fledged lecture, definitely we will be much more enlightened and much more competent and to do the audits in a vigorous manner. So I welcome Chintan Bhai to address our members, and I compliment everybody for joining this particular webinar. Thank you, and over to Saili.
Thank you, Chitra sir. It's always like wonderful to talk to you. And as you rightly said, it's being harmony. You set the tone very nicely that, harmony effect or synergy effect or discipline or the rule book. So you touch based on every aspect being me being a chartered accountant, audits and everything. So yes, as I said, that one of my favorite topics, accounting standards, and yes, there are typical, there are level 1, level 2, level 3, level 4, which Chintan, I'm sure, is going to simplify for all of us, that what are level 1, what are 2 and 3 and 4. So, and what are their particular accounting standards which are not applicable for MSMEs, like for leases or cash flows or discontinuing operations or fixed asset, impairment of fixed assets. So I would definitely be delighted to learn more about this. And to introduce all of us with today's speaker, so let me please welcome Chairman of AS, Indian AS and IFRS Committee of WIC of ICI for year 2021. So Chintan, he is a practicing chartered accountant having more than 18 years of experience. He is, of course, a co-author of a book on Quick Guide to Indian AS and ICBS published by Taxman. He also has his YouTube presence, so he's a mentor and editor of Knowledge Update channel on YouTube. He of course has a hands-on experience on Indian AS, International Gap Conversion, Companies Act 2013, and Risk Advisory, GST, to name the few. So I welcome Chintan Patel to enlighten us for this today's topic. Over to you, Chintan. Thank you.
Thank you so much, Saili, for doing extraordinary MOC. Because when I look at you have been trying to coordinate everything and also speaking on the accounting knowledge.
Yeah.
Even though you said that you have a limited knowledge, but the way you're doing MOC, it seems that you've been involved into AS for so many years. And it's always my pride, privilege, and pleasure to have some session where Chitle sir is there. And when he started and when he sets up the tone, I think the whole session is bound to be a fantastic. Obviously, the responsibility on my shoulder will increase, because when Chitle sir was explaining, I was thinking that I was also trying to understand from him, because he was talking about the background or the background of the of drafting this announcement. I think there's somebody who has been a part of this particular process, somebody who has been studying very closely, and from when you be listen, I think that is something amazing to learn from him always. He mentioned about one incidence of sharing a room. It was actually opportunity given to me, and he was so kind and humble that he allowed me to have a room sharing with him. Otherwise, he was so much busy throughout the night and day. He has been studying on a lot of things of councils, but still he was so much humble at night that some other person was he allowed to me share. And at that time also, I learned a lot of things to be to be on ground, to be humble, to be available for members and students anytime, anywhere. And that's what we learned from him. Chitresh sir, thank you so much for being here. It's my pleasure. MOC is obviously going to share her thought process, but from my point of view, and when I was listening to you, I think the way you explain the complete accounting standard, the reason why ES is required, it was a very briefly and in very easy manner. I think if we all understand the few points which he has mentioned, I would just like to have highlight of these few points to start with my session. First thing he mentioned about the reason why GST audit has gone, the reason why we are struggling to have a tax audit, and the tax audit limit has been increased beyond 10 crore. See, the reason behind all this is also that on responsibility on our shoulder, that we need to ensure the quality of the reporting, quality of the auditing should be improved. And how the quality is measured, the quality of the accounting standard, image of ICI is one of the most important thing, and every one of us has to contribute their bits for the purpose of brand image, brand ICI. So these standards of auditing, these accounting standards, these all are very, very relevant, very important for all of us to ensure that we need to comply when we do audits. So rule book is what? It's nothing but a guidance. What is the best way to prepare your financial statements? The best way to prepare financial statement is being provided to you by your guidance in accounting standards, auditing standards. Otherwise, everybody will do by themselves. Verify, somebody may not verify. That's why the rule book is nothing but the guidance provided by ICI, the compulsory, it need to be basically followed. I think my voice is okay, Siley? Is it okay, or
It is lagging actually. So the network bandwidth probably is low right now.
okay? Is it lagging continuously or in just in between?
Yes, voice was breaking a bit.
Fine, I will just try something to look at my Wi-Fi connection. Fine. Shall I
Now it
go
is
ahead? I think there's
okay. Yes, it is okay right now. So it was breaking in between, but then you may continue right now. So if it happens, I will just give you a text.
right.
Yeah.
Okay, so I'm sharing my presentation to all of you, and I hope it's visible.
Yes, it is.
Yeah. The topic which I'm going to cover here is primarily basically to focus on. First is the announcement issued by ICI dated 31st March 2021. So on March 21, as Chitale sir has mentioned, that the ICAI has issued announcement for revision of the criteria for classification of a non-company entities for the purpose of AS. Second, we're going to focus on the accounting standard which are applicable. I think that is the most important thing for all of us. Why? Because if you are doing audit of ABC partnership firm, then for this partnership firm, which accounting standards are applicable, for which there is exemptions or relaxations, that should be what we should be aware. And next point, I'm going to focus on certain frequently asked questions which are applicable for these kind of things. And lastly, as time permit, we are going to discuss on the commonly observed errors in accounting standards. So these are the main 5-point agendas for the today's session. And as Chitlesh sir mentioned, that this is an opportunity for all of us to really look at and see that how can we improve our practice. The first is on the applicability of AS. I think as we all are aware that AS is applicable here, and here the word which is used is a non-company entity. If you look at the earlier, it was a non-corporate. So when the word is non-company, means every entity which is not a company, they are called non-company. So every entity that is not a company is what? It is a basically the partnership firm, proprietorship firm, LLP, HUF, any entity which is other than non-company to whom which accounting standards are applicable. Why this is required? Because accounting standards are primarily governed by the Companies Act. Companies Act mentioned that to all the companies, AS are compulsory. Plus, there is a mention that, just a minute. I'll just 1 minute for me before I. Okay, fine. Fine. So basically, what is the reason why this kind of standards or announcement is required? Companies Act provides that for all companies, accounting standards or Ind AS as applicable is required. For Ind AS, there is an announcement issued by ICI, announcement issued by MCA, which focuses on the applicability of Ind AS to certain companies. As on today, all listed companies are required to comply with Ind AS. Plus, any company having a net worth of 250 crore or more, they are covered under Ind AS. Additionally, if holding and subsidiary of the companies that are listed, these are required to cover Ind AS, they all are also required to comply with Ind AS. So when you look at this requirement, that means what? That Ind AS, there is a separate set of companies who are required to comply with Ind AS. Other companies are required to comply with ES. Now, what about non-company? So for non-company, there is no regulations, there is no act which governs the books of accounts preparations. So ICI stepped into that particular things, and then the announcement was issued by ICI a long back, wherein it mentioned that for a non-company also, accounting standards are required to be complied with it. So that is first point. Second point is that when we're talking about a classification, earlier the classification was in 3 levels. Now this classification is modified into the 4 levels, right? So earlier there are level 1, level 2, level 3. Now it has been modified to level 1, 2, 3, and 4. The purpose which was underlying for increasing from 3 levels to 4 levels was two. First, to provide relaxation and exemptions, and second thing also to align with the MSME definition, which is generally a coin word for a lot of regulatory authorities. Because we all are aware that MSME is word which has been used, that is a micro, small, medium entities. So that's why level 2, 3, 4 is nothing but the micro, small, medium entities, and level 1 is large. So the 4 levels, level 1 is large, level 2 is a medium, then comes small, and level 4 is micro. So 1, 2, 3, 4, these 4 are the levels which are classified for non-company entities. And another thing which is being highlighted here was that from which date this is effective. So it is effective from accounting period on or after 1st April 2020, right? So here that means what? For financial year 2020-21, today when you do audit for the financial year 2020-21, at that time one has to be very sure that they need to look at which entity is falling in which level. So as per the level to which these particular entities are falling, we need to plan our audit in this fashion so that we are able to comply with these requirements. Now let us look at the levels, under which levels and how they are classified. Why this is relevant? This is just relevant for all of us just to understand that our clients for which we are doing audit, the clients is part of level 1, 2, 3 or 4, and as per that my audit procedure need to be modified. So let us first understand which are the revised classification criteria for level 1, then level 2, level 3 and level 4. Level 1, which says that non-company entities which fall in any one or more of the criteria. So at the end of relevant accounting period, fine. So any one, that is most important, any one or more. So let us look at first thing. It says that entities whose securities are listed or in the process of listing. So दो चीजें यहाँ पे, there are two things which are covered here. That is, if the securities, the word uses securities, that means it includes shares, debentures, or any type of securities. If the securities of any entity is listed or in the process of listing, so it may be in the process of listing on any stock exchange. I think the word, it is any stock exchange, which include multi-commodity exchange, normal our BSC, NSE, or SME platform, whether in India or outside India. So that is always level 1. Then comes a normal situation where banks, financial institutions, or insurance business, they all are a part of my level 2. And then comes these two important criteria. One is on a turnover, and second thing is on a borrowing. So if the turnover of the entity excluding other income, it exceeds rupees 250 crore in the immediately preceding year, so it exceeds rupees 250 crore in the immediately preceding accounting year. That means what? Basically, uh, if we are focusing for the audit 2020-21, for 2021, we need to look at the comparative figure, that is a 1920. Immediately preceding accounting year is 1920. So for the purpose of classification of entity, the turnover of a 2021 is not relevant, but turnover of a 1920 is relevant to understand the AS which is applicable to the entities in the 2021. So in 1920, if the entity which is a partnership firm, company, or they are having the turnover of more than 250 crore, then that is covered here. In case of borrowing, all entities engage in commercial, industrial, or business activities having borrowings including public deposits in excess of rupees 50 crore at any time during the immediately preceding accounting year. So that is what 250 crore and more turnover in 1920, or at any time borrowing that includes public deposits is more than 50 crore at any time, and or the all holding subsidiary of any of the above, right? So that is what it says, that holding or subsidiary of any of the above. If a partnership firm is a subsidiary of another proprietorship firm or partnership firm, then that partnership firm will also be covered into the level of that holding company, which is of higher level. So this is what the level 1 has been defined, and then we let us focus on understand about the other things. uh, Level 2, for level 2 entities, it says that non-company entities which are not level 1 entities but fall in any one or more of the following categories. That is what all activities engage into, uh, all entities engage into commercial, industrial, business activities whose turnover excluding other income exceeds rupees 50 crore but does not exceed rupees 250 crore. So if the turnover is between 50 crore to 250 crore, that is covered under level 2, borrowings. So first 2 points in level 1 were listed or in the process of listing, plus banking insurance, they are already part of level 1. Then comes turnover and borrowing. These two are common for level 2, 3 and 4. So the turnover is between 50 to 250 crore and borrowing is basically 10 to 50 crore rupees. In that case, this is a part of my level 2 entities holding a subsidiary of any one of the above. Come to level 3 entities. All entities engage in a commercial, industrial or business activities whose turnover exceeds rupees 10 crore but does not exceed rupees 50 crore in the immediately preceding accounting year. So here now it is coming to level 3, 10 to 50 crore. We have to be very careful here. 10 to 50 crore is, again, the turnover is for the previous year. So 2021, we have to look at 1920, and borrowing is a 2 to 10 crore rupees. And then lastly, common is holding and subsidiary of any one of the above. So now let us look at and understand this criteria. Level 4 is nothing but the residual category. Anything which is not falling in level 1 or level 2 or level 3 is a level 4. Now, if a partnership firm is covered under level 3, but it is a subsidiary of level 1 entity, then the partnership firm will become a level 1, because holding and subsidiary of any of the entities are always covered with the higher level to which it is applicable. So this is overall snapshot. Snapshot is AS applicability, what we discuss here, as that is on whether listed or in the process of listing. Banking, financial institutions, they all are always a large size enterprise. Then comes a turnover, borrowing cost, borrowing not cost, turnover, borrowing more than 250 crore rupees, more than 50 crore rupees, and a holding or subsidiary of any of the above, that is yes. So here it provides you the overall summary of what we discussed. This is not technical summary. Technical details we had understood in the earlier slide. The overall summary of this says that you have to first look at the listed banking financial institutions. If it is a non-company, it is always level 1. Second thing, the turnover of the entity is more than 250 crore, level 1, 50 to 250, level 2, and 10 to 50 crore is level 3. Borrowing more than 50 crore. Now the question will come, where the borrowing is more than 50 crore, turnover is just 200 crore. Then what? So any or is there. So we need to look at the level 1, because once the borrowing crosses to 50 crore rupees, then it is covered under level 1. That's why in every definition of level 1, 2, 3 says that which are not covered under level 1 are not covered under level 2, right? So this way we need to see, and we need to really look at the auditing for the purpose of our entities. Now, one very important question, which is a question for all of us to understand, and I also want that if you have any questions, please feel free to write a question in the chat box. I'm going to check the chat box as a on regular interval. So any question of you on the topics which we have discussed so far, please feel free to write in chat box. I will be more than happy to respond to your questions. And second thing is that I also want your comments on the question which I discussed right now. That okay, I already have a question from Lalit Bhai. Lalit ji mentioned that do borrowings include OD and CC limit? Yes, Lalit ji, there is no mention of the definition of borrowing, but borrowing means which is a part of secured and unsecured loan. So we need to look at a secured and unsecured loan at any time. So whatever the outstanding balance, not a limit. When you use the word limit, it doesn't mean limit. It's a borrowing outstanding amount at any time. That we have to look at, not a limit. But if you have utilized CC limit, then that amount which is outstanding, that will be counted as part of borrowing. Fine. Any other questions? Please feel free to write in the chat box. I think there is some question in chat. Okay, there is question from Satish ji. Whether non-funded limit should be considered as borrowing. No, in my view, that is not the objective of the funded and non-funded. The borrowing is, we need to look at the balance sheet, and the balance sheet in liability side, the amount outstanding, that what we will look at, not a not funded amount. Okay, fine. So any other questions? So you can put question either in chat box or in Q&A, whatever way is convenient to you. I'm going to check both the things on frequently basis. Now question to all of you, and I request that we are only 43 participants, and that's a fantastic things to learn this years, provided we have interaction. So my humble request to each one of you that please respond to my questions. Sometimes you may be aware about this, sometimes you may not be aware about that, but your response, correct or incorrect, is not critical, but more important is that I want to have interaction on a Sunday morning. So is a tax auditor required to comply with accounting standards while carrying out a tax audit under section 44 AB of non-compliant entities? Now this is a question which we all have to deliberate. Possibly you may be aware about the answer, so please respond to this question in a chat box. Is a tax auditor required to comply with accounting standards while carrying out tax audit under section 44 AB of non-compliant entities? So I'm getting response. When you respond, you can respond to everyone. CS Ali, okay, fine. Ranade, Rashmi madam, Abhijit, very good. Fine. Anybody else? Okay, Bhavesh, yes, fine. See, we all are spending one of the most important and premium time for all of us, that is Sunday morning. Why premium time? Because it's only time for all of us with family, and when we all are able to spend time for education, let us try to learn and understand what these provisions are talking about. So I think the first, Jayanti, yes, thank you so much all of you for being responsive, and let us try to be more interactive and more responsive as we proceed further. So as you all are aware, and as you have rightly responded, that tax auditor is also required to comply with accounting standards while carrying out tax audit under section 44 AB. The answer is known to all of you, including me. However, when you ask or interact with other colleagues or in the office in which we are practicing, the awareness of accounting standard is hardly there. Now let us look at the what this particular provision is coming out. This is governed from the guidance note issued by ICI on tax audit. Paragraph 10.9 of a guidance note on tax audit issued by ICI, it mentions that AS also apply in respect of financial statements audited under section 44 AB of Income Tax Act 1961. Accordingly, members should examine compliance with the mandatory accounting standards when conducting such audit. So here when you look at, that means what, that accounting standards are compulsory, and this guidance note is not a new one. It's a age old guidance note, and the paragraph which is there for so many years. But when I discuss with many professionals, many are unaware. Many have no practices to look at the compliance of AS, because now when you look at, there are two primary responsibilities in tax audit. First responsibility is on reporting on accounts, and second responsibility is reporting on the particulars furnished in Form 3CD. So there are two primary responsibilities. One is a reporting on accounts, and second thing is a reporting on basically particulars furnished in a Form 3CD. The primary focus of all auditors in the tax auditor has been just to look at the correctness of the information that is published in Form 3CD. However, there is a less attention is provided to the reporting on accounts. The reporting on accounts means it is a true and fair, true and correct, and that true and fairness is coming not only from the purpose of the application of the accounting standards. So I think that is what we all need to see. And there's one question about from Bhavesh Bhai. He says that if a lease borrowing cost account standards not applicable to the one entity, then what will be style of reporting? Bhavesh, your question is very relevant and very apt for this particular session. So I'm just keeping this particular point on hold because we have separate discussion on what to report, how to report, what is to disclose, and what is the responsibility as auditor in case of non-compliance. So there is a lot of discussion on that, and I will cover your question at that time. And then if something is there, we can discuss at the time. Bhavesh, I request all of you to please keep your question on hold. Fine. So now coming back to my discussions on tax audit. So our responsibility is not only on the particulars furnished in Form 3CD, it is also on reporting on accounts. Now, a question to all of you. A question to all of you. If an entity is following ICDS, if an entity is following ICDS, is this okay, or account standards are still required? If an entity is preparing ICDS, do you feel there is also need to comply with AS, and how ICDS and AS are different? Anybody please share your thought process on ICDS compared to AS. Okay, Satish ji mentioned that basically yes, ICDS, even though the entity is following ICDS, then AS are applicable. Lalit ji mentioned that it do not cover all AS. So Lalit bhai, you are saying that okay, fine. ICDS are not for all AS. Okay. Jayanti mentioned AS required ICDS declared by IT department, and Abhijit ji mentioned that ICDS under IT Act. So I can see the similar persons are giving response. So my special thanks to all of you, because we so much responsive to that thing. Manoj bhai, non-compliance of AS need to be reported. Fine. Now let us look at first ICDS. What is the purpose of ICDS? Why ICDS was introduced? There are certain sets of companies who are preparing accounting standards, and there are certain sets of companies who are preparing Indian accounting standards. So there are AS and Ind AS on which the accounts are prepared. For the purpose of income tax computation, the profit as declared in accounts are taken as a base. Now, certain companies prepare Ind AS, certain company prepares AS. Then how can we have a profit for the purpose of how can we have profit we can consider as per accounts for the purpose of income tax computation? So with that objective, Income Tax Department, Income Tax Act has enabled the provisions of ICDS. The ICDS name as itself suggests, it is income computation disclosure standards. So the standards are not for preparing accounts. It says income computation and disclosure. So when you talk about income computation and disclosure, so disclosure is governed by Form 3CD. There in Form 3CD, there is a separate clause which talks about a disclosure of ICDS. And in Form, so income computation is what? For the computing income, which is taxable under Income Tax Act, you need to ensure and you need to make adjustment which is required by ICDS. So accounts are required to be prepared only and only either by AS or by Ind AS. For the purpose of computation and for disclosures, ICDS are applicable. So I hope that is clear to all of you. Any questions on that? You can put questions either in chat box or in Q&A. That both are options okay. And fine. Satish ji also has given one question. I will touch upon question later on, Satish bhai, because this question also I covered in my presentation. Okay. So now let us look at basically the next important point, and another question to all of you. Sunday morning, and the Sunday morning I'm just giving some food for thought, and that food for thought is this question: is accounting standards applicable in case of charitable or religious organizations? If you are doing the audit of charitable or religious organizations, is it applicable? Okay, Ranadi ji mentioned that yes, applicable to trust as well. Rashmi mentioned yes. Anybody else? Jayanti, level 4 entities, fine. Shashikant, yes. Should be okay. Abhijit should be fine. Uh, oh, great, fantastic. So I think one of the most relevant and most important response which has been provided is from Satish ji. Satish ji has really hit the one of the most important thing. Yes, if it had any business, trade or commerce. So the focus of this particular question is to just give you the reasoning. The accounting standards are applicable if and for any entity having a commercial or business activity. If a charitable or religious organization do not have any commercial or business activities, in that case, accounting standards are not applicable. So let us look at why and what is the reason. When we talk about these definitions, we have seen here that it says commercial, industrial or business activities having borrowing. Again, I think somebody mentioned level 4, but the focus of accounting standards are only and only for the purpose of commercial, industrial or business activities. And in that case here, basically this is not applicable because it is governed by a separate act, and that act need to be governed for the purpose of these things. Satish ji mentioned collecting donation and distributing amounts beneficiary may not need ES to apply. Yes, Satish ji, you replied correctly that it is not required. Now coming to the next point is on taxation audit quality review. See, TAQRB, that is the short form of Taxation Audit Quality Review Board, TAQRB. How many of you are aware about this TAQRB? Probably very less or may not be aware about this. This TAQRB was established a year back by ICI with the objective to review the taxation audit. The word is a taxation audit. Now the taxation audit includes tax audit and GST audit. Now GST audit is not there, but however, whenever it was there, it was covered in the taxation audit or GST audit. So the ICA was aiming that there is always a lot of issues from the government regulatory agencies about the quality of the tax audit reporting. And then the questions has been raised what the ICA has been done to ensure the quality of tax audit is of the high level. So that was the question. That is the reason why the ICI has taken initiative to have a review, internal review. You may have heard about a Financial Reporting Review Board, FRRB, and the Financial Reporting Review Board, they select the companies and then they do review, and the non-compliances are being referred. Like FRRB, now the Taxation Audit Quality Review Board, now the scope is tax audit and GST audit. GST audit and tax audit, ये दोनों का scope है, and the selection of this is done either suo motu or by reference by a regulatory authorities. If CBIC or Income Tax Department or any other functions give a reference to ICI for certain tax audit or GST audit, then it can be covered as a part of the selection. Or in case if any irregularities are mentioned by media, which requires the attention of ICI, then on that basis also this can be selected. So what is the focus? Focus is to just ensure that there is an internal mechanism in ICI to review the quality of the tax audit and GST audit, and then to take action where is required. Once the particular case is selected for the review, and if the discrepancies are observed, and if the discrepancies which are observed are of material nature, then this board can refer the matter to the disciplinary committee for action. If it is not of a material nature, in such case, then it can be given attention to the auditor for taking care in the future. So that is what the main objective of TAQRB. At these junctures, they have covered all companies which are listed in the process listing, then their banking insurance company, and entities which is having a turnover of more than 100 crore. That is the actual selection criteria for the purpose of this particular review point. Coming to next point is on, I think Shashikant ji mentioned, if no commercial activities are borrowing by trust and institution, then without applying AS, how can we certify true and fair view? Shashikant ji, basically, as we are doing accounting standards, the same way, even though you don't apply AS, doesn't mean that it is not true and fair view. So when you look at true and fair view, we also apply the assumptions of accrual basis of accounting or cash basis of accounting. We can also verify and check the documents which are attached. We can look at the bank's cash receipt, everything. So the you are rightly mentioning the point that accounting standard is the guidance. It's a base, which is the rule book, which you do comply with it. But however, for trust, which is not a charity, which is not a business activities, this is not a mandatory applicable. Now, obviously, we can refer to this as a base. It is not mandatory. Yes, we can refer to this as base for the purpose of giving our report. Now, coming to the accounting standards that are applicable. Level 1 to comply with in full with all accounting standards. When you look at this requirement, you will find that out of this AS1 to AS9, which I mentioned here, AS1, that is disclosure of accounting policies, is applicable. AS2 is applicable to all. So here, irrespective of level 2, 3, and 4, AS1 to AS4, AS5, AS7, and AS9. These all are, if you look at, they all are applicable here. Only exemption is given to AS3 cash flow statements. AS3 cash flow statement is not actually applicable in case of basically level 2, 3, and level 4. To level 1 entities, yes, AS3 cash flow is applicable, but not applicable to level 2, 3, and 4 entities. Right. Coming to the next point is on the accounting standard applicability for next. I think Abhijit, you want to mention something? Fine. I have not received. Okay. We are understanding details. Thanks, but can't remember. Shall be thankful if later PPT share. Sir, I will share my PPT. There is no need to worry about that because my focus is to really have interaction today. Don't worry about writing notes. The presentation will be given to Pune branch, and Pune branch will upload on the website, and everybody will get the presentation. So there is no need to write down your notes. Just try to be focused. Let us have interactions. Let us have discussions. And the objective is to learn and interact from each other. Fine. Coming to the next sets of standards, AS10 to AS20. AS10 to AS20 here. In AS10 to 20, here we're going to look at the first is PPE. In PPE, there it is applicable. Yes, DE. Here DE is what? Disclosure exemption. So wherever there is a mention of DE, that means a disclosure exemptions. So the standard is applicable. However, the disclosure exemption, there is exemption from some disclosures, that is DE. So my focus here is that basically that when you say applicability of account standards, it is not only the measurement criteria, because our primary focus is on measurement, because measurement means on the balance sheet P&L account, it will impact profit. But accounting standard applicability doesn't mean only measurement. It includes scope, recognition, measurement, and disclosure requirements. So when the whole accounting standard is applicable, we need to also look at the disclosure in notes on accounts to the particular entity's tax audit report. Right? So whenever there is a disclosure exemption, only in that standards there is exemptions. Other than that, there's no exemptions, right? So other than where there is, yes, like AS7, under AS7, AS9, construction contract revenue recognitions, there is no mention of a disclosure exemption. If there's no mention of disclosure exemption, means you also have to disclose AS7 construction contract related note, which requires you to disclose the work in progress, how much is completed, percentage of completion method. So these all are required to disclose in your notes on accounts. So I hope now it's clear that when we talk about the accounting standard applicability, it means all AS, 100% AS, which includes recognition, measurement, disclosure, everything. Wherever the exemption is provided, either disclosure or some of the exemptions, there is a mention here. Rest, when the yes is mentioned, that means 100% AS is required to comply with it. Now, when you look at AS10 and AS11, under AS10 and AS11, if it is a level 2, 3, 4, in that case, this is applicable. However, there is exemptions for level 3 and level 4 entities. Government grants, it's applicable. Investments, applicable. Only there's a disclosure exemptions for level 4. Amalgamation, it is yes, NA strict, we'll discuss NA strict later on. Employee benefits, there is separate discussions as far as employee benefit is concerned. Here it says that, like, so this will discuss separately, because for employee benefit AS15, separate classification, a separate thing is provided, and to which entity it is applicable. Borrowing cost, applicable. Segment reporting, it is not applicable to 2, 3, 4. RPT, applicable only for level 2. Leases, applicable, but however there are disclosure exemption for that. And earning per share, it is not applicable. Coming to the next part is on this AS21 to basically 29. So in 21 to 29, if you look at here, 21, it is saying asterisk. So I'm just focusing now. What do you mean asterisk means? You'll find under joint venture asterisk, 21 asterisk, interim reporting is asterisk. That means what the ICI is saying, that generally for non-company entities, they do not have a subsidiary, associate, joint venture, interim reporting. So that is the reason why to them these standards are not applicable practically. However, if any non-company entity has a subsidiary or associate or joint venture, and if they are required to prepare consolidated financial statements, in that case they need to follow these standards, right? So if you're not required to do it, then requirement will be governed by the having a subsidiary, associate, joint ventures, and the requirement to have CFS. If it is not there, then there is no need to comply with it. So these are practically not applicable standards. That's why it say NA with asterisk. And look at here, AS22, accounting for income taxes. It says that applicable, yes. This is one of the most critical standards. Even I have seen non-compliance of accounting for income tax, deferred tax in majority of the companies. Now, but when you look at here, it is also applicable to the level 2 and level 3 entities. And for level 4, there are certain restrictions provided for level 4. We'll discuss about the AS15, AS22, and AS28 separately, because these three standards require deliberation, because there are different kind of exemptions provided here. This is an overall snapshot of what we discuss about the number of standards which is applicable here. When you look at here, I think first for all of us, the most important thing is that if you are doing a tax audit, as we discussed that for tax auditor, turnover is a more than 10 crore. So it will definitely be either level 3, level 2, or level 1, right? So please be very sure that any tax audit which we do, they are at least level 3. It can be level 2, it can be level 1. So if it is level 3, then there are 12 standards which are 100% applicable. There are 5 standards which are applicable, but there is a disclosure exemptions. So 12 plus 5, 70. And there is a 1 standard, it is applicable, but there are certain exemption provided. So even for level 3 entities, 12 plus 5, 17 plus 1, 18 A's are applicable even for level 3. And as you move forward from level 3 to level 2 to level 1, then you find the number of standards applicable have increased. So again, my focus here is to just provide a brief idea to all of us, saying that turnover more than 10 crore is 44 AB. So when the turnover is more than 10 crore, 44 AB, you are doing it, you have to ensure that at least level 3 related standards are being complied with it. And then based on the turnover, based on the borrowing criteria, it can be level 2 or level 1. Now, just a brief listing of accounting standard which are applicable to all four categories of non-company entities. There are 8 A's which are applicable to all four. So level 1, 2, 3, 4, irrespective of the size, irrespective of the nature, irrespective of the turnover, irrespective of the borrowing, if it is non-company entities, all four categories are applicable, which includes AS1, that is a disclosure of accounting policy. See, mind well, when you look at untaxed audit, in the tax audit, there's a notes on accounts. And notes on account first is a significant accounting policy. So the significant accounting policy is the requirement of AS1, and then we do ensure that the significant accounting policy which have been used for the purpose of preparation and maintenance of accounts has to be mentioned there. Second is on AS2, that is valuation of inventories. Then AS4, that is contingencies and events occurring after the balance sheet date. AS5, net profit or loss, prior period items and changes in accounting policy. AS7, construction contracts. AS9, revenue recognition. AS12, accounting for government grants. AS16, borrowing cost. So these are the 8 standards which are applicable to all 4 levels, no exemptions, and it is must for everybody. Coming to the next important point is on the list of standard. So that includes mainly the bunch of consolidations, associate, joint venture, that is bunch which is covered here. And then comes interim financial reporting. So if you look at here, it focuses on 7 standards which are entirely not applicable. Consolidating cash flow statements, cash flow segment reporting, EPS. So these 3 are very, very relevant. Then it's consolidated, associate, interim reporting, joint ventures. So these 3 are not these categories of non-company entities. Now we are discussing and we are focusing on AS15 employee benefits. If any questions so far, please write down in chat box or Q&A. Certain questions which are pending, I am aware about that, and that question I will deal with when this particular topic is covered in the PPT. But and then we all can learn from your questions. Coming to the AS15 employee benefits. Before I talk about the exemptions or restrictions, let us have first a brief overview of AS15. The brief overview is AS15. There are 4 categories of classification of employee benefits. First is a short-term employee benefits. Second is the post-employment benefit plans. Third is a termination benefit. And fourth is other long-term employee benefits. Short-term employment benefits are generally salary, wages. These all are short-term. Post-employment benefit plans, which includes gratuity, pension, they are called post-employment. Benefits are paid after employment. Third is a termination. One of the most important example of that is a voluntary retirement scheme, VRS. And fourth is other long-term, so which are not a short-term, which are not covered in any of these 3. It is called residual category. Then it is called other long-term employee benefits plans. Now, generally exemptions or restrictions are provided based on turnover criteria or borrowings. However, for employee benefits, the turnover is not relevant. For example, there is a service related entity, IT industry. They have 100 employees. Their turnover is just 8 crore rupees. And if that particular entity is not following employee benefits, is it fair? Not fair. So the exemptions for AS15 is primarily governed not by the turnover or borrowing. It is primarily governed by the number of employees in which the entity is having. So that's why there are 2 classifications. One is the entities whose average number of persons employed during the year is a 50 or more. Okay, before that, there's some question from Rashmi. Is it necessary to specify in notes expressly about AS which are not applicable, or is it will be conducted that AS is not applicable as it is not reported? Rashmi, I have a specific slide on this point, and then I will discuss it at that point. And in case your question is unanswered, we'll discuss at that time. I'm sure that it will cover in my slide itself. Okay, entities whose average number of persons employed during the year is 50 or more. Now, that has called a little large size entities, go 50 or more is there. So that's why here there are 4 exemptions provided. First thing which is focusing is on a short-term compensated absences. Now, short-term compensated absences, here it says that this one, provided these are not wasting. Now we'll discuss on these short-term compensated absences which are not wasting. Compensated absences is nothing but a leave encashment. Leave. Short term means it cannot be beyond 12 months from reporting date. So short term compensated absences, that is a leave encashment not beyond 12 months, that is short term in nature. However, which are not wasting. Not wasting means it is not, if any employee resigns next year, then the encashment of that leave is not allowed. That is called non-vesting. Vesting means what, that basically once the employee resigns, whatever balance is there, that balance I have to make payment to that particular employee. That is called encashment. Otherwise, what will happen? He can carry forward next year. If he's in leave, no issue. We can adjust and we will not deduct salary. That is called non-vesting. So if it is a short-term accumulated compensated absences which are not wasting, then you are exempted from doing accounting for level 2, 3, and 4. Coming to the next point which is focusing on payment to defined contribution plan and termination benefits. So defined contribution plan payment, that is what, see, in post-employment benefit plan, there are 2 plans. One is defined contribution, second is defined benefit. In defined contribution plan, the amount paid is certain, that is my liability is limited to the amount paid or payable. In defined benefit plan, my liability is not limited to the amount paid or payable. That is called defined benefit plan. In defined contribution plan and termination benefit, where the scheme or arrangement or the obligation is such that the amount is to be paid after more than 12 months. So then the discounting is required as per AS 15. So as on 31st March 2021, if the termination benefit scheme is there which says that I have to make payment in July 2023, which is after more than 12 months, then discounting of that need to be done as per AS 15. So from that, there is exemptions to even entities which are having a more than 50 employees. There is no need to do discounting by them. Next point is on post-employment defined benefit plans. So for defined benefit plans under AS 15, there is a lot of discussions, a lot of clarifications, classification of in actuarial loss, curtailment, settlement. So here the standard says that even though your employees are more than 50, you can just actuarially you can compute your liability by following PUC method, projected unit credit method, projected unit credit method. You can calculate your actual liability. That is fair. There is no need to go beyond that. There is no need to look at the curtailment, settlement, actuarial loss, all provisions. So by just measuring by way of PUC method is enough for you for compliance. Same way for other long-term employee benefits, you can measure by PUC method. That is sufficient compliance for AS 15. So that is what is being discussed here on employees are when more than 50 or more. Coming to the next point, where the employees are less than 50. Non-company entities where employees are less than 50. In that case, it says that first, First 2 points which what we discussed is a short-term accumulated compensation absences and payment to defined contribution plan, termination benefits. They both are the same as we discussed for more than 50 employees. So there is no variation, there is no difference as far as more than 50 and less than 50 is concerned for first two exemption. For point number 3 and 4, if you are a level 2, level 3 and level 4, and if your average number of persons employed in the year is less than 50, in that case, you can compute your defined benefit plan or other long-term employment benefits by way of any rational method. Rational means you can do Excel-based competition of number of employees with your company. Then also you can go ahead with the number of employees plus the assumptions salary as on the date. So by any other rational method, you can compute the liability. But there is no exemptions. Please mind well, there is no exemption from providing liability. Liability of gratuity, leave encashments as required, it has to be provided. There is only exemptions or relaxations is from the way of computing, the way of providing disclosures, which is based on number of employees with the entities. I hope that is clear. If any questions, please feel free to write a questions about what we discussed in AS15 or earlier part in the chat box. Coming to the next part is on AS22, that is for accounting for taxes on income. Under AS22, I think the critical thing under AS22 is what? Deferred tax computations. Even if we refer to the company's annual report, notes and accounts, will have you observed that the computation of deferred tax is not generally appropriate. For non-company entities also, the deferred tax is applicable, right? So let us look at this disclosure requirement. Exemption is what? Exemption is provided only to the level 4 entities, where it says that if you are level 4, then you can do only current tax. There is no need to do deferred tax. Now, as I mentioned, the level 3 is turnover more than 10 crore. So any tax audit which you are doing it, where turnover is ought to be more than 10 crore, in that case, deferred tax competition is compulsory. There is no relaxation to you for doing deferred tax competition for level 3, level 2, and level 1. If you are on level 4, then you can do only current tax. And in case if you are level 4, and if you are having some deferred tax balances of earlier level 3, level 2, then you can adjust with the opening return earning when you move to level 4. Coming to next part is on AS28, that is impairment of assets. Level 2, level 3, level 4, there are disclosure exemptions for level 2 and level 3. Level 4, it is not applicable. As far as the exemption is concerned for level 2 and level 3, value in use under AS28 is required to be measured by a present value of the future cash flow. Under this realization, it says that you can also do reasonable estimate instead of going by way of the present value of future cash flows. So that is the exemptions or relaxation is provided under AS28 for the measuring by way of a reasonable estimate rather than by measuring by way of the value in use. Now coming to a very, very important part, which I already received questions earlier, and that is about a disclosure in financial statements if you avail exemptions or relaxations. First point, fact of being MSME and level is required to be mentioned, right? So fact of being MSME is what you in a notes on accounts. Generally, if you look at in companies, there is a first note is about the company. So in the first note itself, you can mention there is no. So right now, what I'm talking about is a general guidance. There is no requirement that you to mention only first, but obviously it is better to write down the first paragraph of notes and accounts that you are a small entity or micro or medium as far as the definition of the MSME is governed by ICI. And also you can mention that which level you are. Are you level 2 or level 3 or level 4? That will also make it very clear that the users can understand, readers can understand the accounting standard which are being complied with it are as applicable to the level 2 or level 3 as per what is disclosed in notes on accounts. So first thing that you should disclose in notes account fact of being MSME and the level to which you belongs. Second thing, you can mention the compliance with accounting standards. These are as applicable. So you have reviewed the AS that are applicable as per the level to which the entity belongs. So that is to be that particular reference is can be provided here. Now coming to the uh, upgrade in case entity is no longer eligible for exemptions that is availed in previous period. So for example, you are part of level 3. Next year move to level 2. There are certain exemption which is provided under level 3, not in level 2. So the year in which you are in level 2, in that year you have to follow level 2 applicable AS. There is no need to revise or modify prior period things. When you move from a level 3 to level 2, when you go upgrade. If you downgrade, that means you entity is becoming eligible for relaxations. So earlier you are level 2, now you are downgrade to level 3. So there are few accounting standards which are now you are eligible for exemption or relaxation which you applied compared with earlier. So for that, ICAI says that for 2 years you are under watch list. For 2 years consecutively, if you are remain in that downgrade status, then from third year onwards you can apply the downgrade status. So for 2 years, if you stay in level 3, then you have to continue to comply with the level 2 requirements and avail exemptions which is applicable to your case for level 3 entities. That is what is discussion on here. And so as question was there, in case we availed any exemptions or relaxations from disclosure of accounting standards, or if you availed any exemptions or relaxations from disclosure of accounting standards, then that particular things should be provided as a disclosure in your notes on accounts. So I hope I'm able to provide response to the questions which you discussed. I think there was only a question by Rashmi about is it necessary to specify in the notes expressly about AS. That is I think covered here. And also I think there is another question was on some disclosure part. Okay, so here Bhavesh also mentioned if the lease borrowing had to be mentioned, not be mentioned. Yes, I think we discussed both this point. So I hope I am able to reply to your questions appropriately. In case if still something is unanswered, now please let me know in chat box. I will be more than happy to respond. Another question is from Rashmi, where number of employees are handful and ESIAC and PF are also not applicable. Still, as per provisions of gratuity, is it required to be provided as per AS? Yes, Rashmi, basically there is no exemptions provided here. Even though number of employees are handful, because the number of employees may be handful, however, the impact can be material based on the number of years for which companies under operations. So there is no exemption is provided under AS. You can take your own call as far as this is required.
Chintan, only if that act itself is not applicable, if there are 2 employees only, then one will have to take a view.
If there are 2 employees, then sir, it is not applicable.
No, then payment of gratuity, there are minimum number of employees, some 10 employees.
Oh.
So if it's a contractual employment, it's another thing. You may still apply it, but if the number of employees are less than qualifying number of employees, then that liability itself may not attract.
Yeah, so Chitra is saying if the gratuity liability itself is not applicable because of the Payment of Gratuity Act is not there, in that case, obviously there is no need to worry about that. But however, if you are liable under some act, then number of employees not critical. You need to really look at and then you do comply with it. Fine. One more question from Shashikant ji. He mentioned that employee includes only those are on payroll. So employees means what you define as employee. There is no definition. You can look at AS 15. Under AS 15, it talks about any kind of employees. So that is what is covered here. Coming to next important point is on basically the auditor's responsibility. This particular point was also touched upon by Chitra sir, but however, I want your response. If you are a tax auditor of a non-company entity, and if you identify certain non-compliances, then what is the duty of an auditor in case the accounting standards are not compliant with it? Please respond in a chat box that what do you feel is your duty in case you find certain accounting standards are not compliant with it. Is there any need to provide any disclosure requirement? Shall we provide any disclosure requirement? Some examples, some in notes on accounts or in auditor's report, anywhere, whether we have to mention that information? Yeah, Rashmi responded as an auditor, we should report. Fine. Anything else? Okay. So basically, first thing is that non-compliance is which kind of non-compliance? Is it material non-compliance or it is immaterial? In both the case, the reporting should be done. If it is material non-compliance which affects true and fair, then obviously it's qualification. If it's a non-material non-compliance, then the reporting definitely is there under Form 3CA and Form 3CB. So Form 3CA for a company, Form 3CB for non-company. There's a clause 3 and clause 5 that focuses on observations, qualifications, reservations, comments. So in that particular aspect, you have to basically provide all your comments as far as the non-compliance is concerned. And as Abhijit has rightly asked question, impact need to be given. If you look at the standard of auditing, where it says that in case of qualification, quantification is required. So wherever is a material non-compliances, and then if you're doing kind of qualifications, then yes, quantification should be provided. Coming to next point is on basically what is the duty of auditor in case of financial statements prepared on a basis other than accrual. I'm again looking for your response to here. For example, if you during the course of tax audit you come across an entity which is a professional, is a partnership firm, and they are preparing their accounts as per cash basis of accounting. Now, what is the duty as auditor? Is it allowed? Whether cash basis of accounting is allowed if they're not preparing on accrual basis of accounting? Then what is to be done? If it is allowed, then it's okay. If it's not allowed, then what is to be done here? Anybody else here, please? You come across a tax audit of an entity which they prepare their accounts based on the cash basis of accounting. Okay, first Manish mentioned that it is to be disclosed as accounting policy. So in your notes on accounts, it should disclose that accounts are prepared based on cash basis of accounting. Fine. Okay, fair. Any other duty on our part? For a business, accrual is necessary. Fantastic. Abhijit mentioned that accrual basis of accounting is mandatory. See, basically, one point is very clear for all of us that the fundamental accounting exemption says that accounts are prepared based on accrual basis of accounting. So, in normal case, if the accounts are not prepared on accrual basis, we have to qualify. If the accounts are prepared on cash basis of accounting, because Section 145 of Income Tax Act that allows certain individuals to Section 44A of the accounts, which 44A of the Income Tax Act, which allows professionals to prepare accounts under cash basis of accounting, then in notes on accounts that fact to be mentioned, and in the auditor's comment Form 3CA 3CB we should also mention that particular fact, because it is not a non-compliance, because Income Tax Act allows. However, it is a duty on our part to draw the attention, because this is a accounting assumption which is not followed, so that it should be in notes on account also, and also should mention and refer into auditor's report.
Yeah, only if I may refine, as far as tax audit is concerned, this particular cash basis is allowed because the proprietary law, there is no law for proprietorship, law for partnership is silent on this. So even following cash basis of accounting would be appropriate. And I think income tax law does not distinguish between professionals and business. Even business, even manufacturing proprietorship can follow cash basis. That is what I believe. And once the cash basis is followed, no accounting standards would be mandatory because they are for the purpose of accrual basis of accounting. But in that case only ICDS will come into play, and there one will have to really disclose the accounting policies. But even ICDSs are not applicable to cash basis accounting. So that one may have to really revisit.
Yeah, so basically, I think Chitla sir, there is in ICI guidance note on tax audit, which is issued by ICI. They have mentioned and covered this as a separate question in guidance note, and it mentioned that if the
Question
capital
which
account,
mode of accounting is followed, so there one has to answer it is cash basis. But because a
yes,
cash basis is following, there cannot be any impairment on true and fair view. Based on that accounting policy, the view may be true and fair. Of course, as a chartered accountants, we know that really in commercial world, there cannot be fair view once cash basis is followed. And rather, it may be more vogue in case of charitable institutions for obvious reasons.
yes. So basically, see, okay, ultimately, as a responsibility of auditor should be to really draw the attention of the readers by our notes on accounts, and also to mention in the auditor's report, because as an auditor we should mention the fact and draw attention to the readers, because whenever the chartered account signs, we carry a lot of responsibility on our shoulder, and it is being believed that the accounts are compliant with it. So if something is not being done appropriately, or because of it is allowed, if it is not allowed, it is done, it is qualification. If it is allowed, it is done. However, it is not as per accrual, which is the assumptions. Then I think we should provide in the notes on accounts also, and we should put comment in a form 3C 3CP. Next point, let us look at is on UDIN. Whether UDIN is required for non-corporate entities which are not subject to audit. So I think the focus and objective here is that in case if the non-corporate audit, which is not covered under tax audit, if it's tax audit, we all are aware the UDIN is compulsory. If the tax audit is not allowed, however, the clients ask you, okay, for the purpose of bank audit, I need the audit report. So in that case, what you do, you carry out audit and you issue audit report, which is given by SS 700. So under SS 700 illustration 4, which provides the format of that particular things, you use that SS 700 format, and then you provide the audit report. Now, question is that are you required to generate UDIN for that? Answer is yes. For all attestations, all certifications, there is a need to generate UDIN. There is no exemption, exception, even though it is not a tax audit. So that is basically yes. Yeah. Okay. There is one question. Okay. No, I think there is no questions. Right. Coming next one point is on WRC publication on account standards. Last year in WRC of ICI, we have issued a publication to provide a model format of financial statements for a non-corporate entity. I think the objective was that there is no format which was prescribed by any standards. And there are many questions which has been raised about the format to be followed for that. So last year, the model format for a non-corporate entities was published. During current year, what I've done that we have revised the publication by keeping in mind the ICI announcement dated 31st March 2021, which prescribes the criteria classification which are revised in nature. So the publication is undergo and it is ready. Maybe in a couple of days we are going to launch the publication, which is going to include the accounting standard applicability, exemption or restriction list, frequently asked questions, model auditors report, because we also raised a question about the audit report to be included, financial statements and appendix of ICI. So that I am sure that it will be useful to all of you. Plus, there's a listing of resources which are very, very important for all of us. There is ICI announcement, then there is accounting standard quick referencer, recently issued by ICI for micro non-company entities, model financial statement which I discussed, account standards, quick references, and compendium of AS. So these are the all resources which may be useful to you to understand the compliance of AS when you carry out our tax audit or for other audit point of view. Then coming next point, let me just come at the commonly found errors here as my next topic as the time permits. Before that, let me see if any questions are there. In case of doctors, we are following cash method. Of for this, we are in audit. As per discussion, just no, I had conducted that we are not supposed to report and comment on it as even for the year onwards. I'm unable to understand Rashmi your question. You say in case of doctors, we are following cash method. For those, we are in audit. As per discussion, just no, we had. Can I conclude that we are not supposed to report and comment on as even for the Rashmi, as we discussed, I think if you're following cash reserve accounting, then the notes on accounts, the disclosure has to be there that the accounts are prepared based on cash reserve accounting. And as an auditor, it's a prudence practice to refer to this particular thing in your form 3CA, 3CB. I hope that is clear. And let me look at a Q&A box before I move to further point. Okay, Satish Jim, you asked question. Can you please share if you had standard notes? Sir, standard notes for non-company clients we have prepared. And as I mentioned, that last year the model financial statements are available on WSFIC website. From that you can download the standard notes on accounts, accounting policy. Everything is provided there, and the new publication is going to be there very soon. Rent received by trust, then whether ES required, sir. As we discussed, that trust, if it is completely a charitable, then there is no need to worry on that ES point of view. Why number of employees not in line with labor laws, which nowadays a point of action from respective department. Sir, number of employees and labor laws are different thing altogether. When we talk about the number of employees in ICI for AS, the focus was on materiality on financial statements. So that was the reason. But yes, number of labor laws, I think it is 10 or 20. So this is a 50. So these both are on different footing. There is a reason why this has been done. In case of contractual employment or manpower supplied by an agency, to me, being a principal employer, you should ensure compliance with respective account act and disclose along with true and fair view with respect to account. Yes, we should comply with account standards and it should disclose as appropriate. Fine. So any other points? No. So I will move further and to next part of our presentation, which is on commonly found errors in financial statements related to accounting standards. See, before I proceed on this point, my objective of this session was primarily twofold. First is to brief you about our responsibility as an auditor. Second, one of the most important thing is ICA announcement on 31st March, which focuses on the revised classification. Third, as a tax auditor, what is expected from you. Fourth is to touch upon the certain commonly found errors. Financial Reporting Review Board, FRB of ICI, as you are aware that they are reviewing the financial statements. And from the review financial statements, the errors which they observe, they all are compiled in one publication. So that is available on ICA websites. From the compendium of FRB for commonly observed errors, I have selected few only for the purpose of your attention and with the objective which is being mentioned here. Just look at what Warren Buffett has said. He said it's good to learn from your mistakes. It is better to learn from other people's mistakes. I think everybody we have to learn from other people's mistakes. That is better, because there is no need to do mistake by myself and then learn. Let us learn from what others have done, and then we should try not to repeat this mistake in our case. So with this objective in mind, this particular presentation is being prepared on this. If you look at the number of AS and the chart which is provided here AS1 5.1% non-compliance, AS2 4.7%, AS3 8.1%. Then there is AS11, AS13, AS15 employee benefits 7.3%, AS18 related party transaction 4.4%, AS22 deferred tax 5.1%, then 26 3.7%. So these are the non-compliances generally observed. And what I will do, I will just have a glance over the non-compliance which are being talking here, and then we'll focus here. Let me see if you're in chat box. There's some questions are there. Contract labor will be included in the number of employees for AS for employee benefits. Fine. Yes. Thank you for providing information. Okay. Coming to non-compliance of AS1 to AS10. Let us look at first on AS1. Disclosure of accounting policy. Certain companies omit to disclose significant accounting policies with regard to the following: borrowing cost, valuation of inventories, accounting for inventories, employee benefits, accounting for taxes on income, impairment of assets, provisions, contingent liability, contingent assets. See, here I would would like to pause for a few minutes and just talk about one of the very important thing. Significant accounting policy are must to be disclosed in notes on accounts. So even if you are auditor of a company, even if you are tax auditor in a company, there are notes on account should include significant accounting policy. Why this is critical? For any readers who are reading the financial statements, how can they understand how the accounting is done? So the accounting how is done is being explained by the accounting policy. So accounting policy provides the readers guidance about the accounting treatment which may have done in the financial statements. So the significant accounting policy, if it is applicable and if it is not disclosed, it is something which is very critical, and then we need to be really sure. So what can be done as a practice? As a practice, we can have our standard format in your own firm. Every firm should have a standard format of the notes and accounting policy. That standard format should be modified in every engagement just to ensure that it really fits to the particular company to which it belongs. One of the most important things which we do look for when we do modify is a revenue recognition policy. In certain cases, I have seen that the company is in the service industry and the revenue policy says that revenue is recognized when the goods are dispatched. So your revenue recognition is something which is very, very specific to the companies, and that you have to ensure that it is being modified. So my humble request to all of you that let's have a policy in our every system in our firm where we should have a draft accounting policy ready, and it should be modified and applied in every notes accounts whenever we do it. Coming to AS2 inventories, incorrect disclosure of valuation of inventory. Now I am just focusing on the certain live cases where the accounting policy was disclosed that is being reflected here. If you look at the first point, it says stock of the cards are valued at cost and on FIFO basis and include all applicable overheads in bringing the inventories to the present location and condition. Work in progress is valued cost. Now what you identify is wrong here? Can anybody respond? Is there any wrong here? Do you feel anything wrong here as far as this is concerned? Before you, as you take some time to respond here and go through, I'm just responding to a question which I have received from Rashmi that in case of how to, so basically, see, if I just give you a yardstick, Rashmi, whether you do include in Form 3CA, 3CB or in Form 3CD, it all depends upon the materiality of the non-compliances and the observations, comments. I'm not sure about the space, how much is being available where in Form 3CD, Form 3C, 3CB. But in my view, in Form 3CD notes on accounts, you can upload notes on accounts. I think there is no bar on uploading your scan copy of Form 3CD notes on accounts to financial statements, because there is a space where you have to upload or sign the balance sheet P&L account along with the notes on accounts. So I think there is no space on that aspect. But I'm not very much sure on tax point of view if Chitle sir can guide here. Otherwise,
Sorry, what is the question?
Anybody who is expert. Yes, sir.
No, what is the issue?
Yes, sir.
Slightly.
Yeah, so issue, his issue is that when we upload in Form 3CD, or is there a space issue for writing notes on accounts, or there is no space issue?
See, as far as notes on accounts are concerned, by the very title, it is responsibility of the assessee to put those notes on accounts in accounts, because they are notes to accounts and not notes to audit report. If there are notes to audit report, then maybe you will have to ensure whether they are enclosed, not enclosed. But notes to accounts is responsibility of the client or the auditee. And secondly, accounts are not complete without notes on accounts. So notes on account is part and parcel of notes on accounts. If you look at first or second page of balance sheet or statement of profit and loss, after all those schedules, at the end we write notes on accounts and we write some schedule number. So they form part of this financial statements, and therefore along with financial statements, notes on accounts should be uploaded. Otherwise, that those financial statements may not be complete, and it is not responsibility of a chartered accountant or auditor to do so, but as a consultant he will have to guide client that also you include uploading of those statements, notes on accounts as well.
Yes, exactly. So basically, you can upload with balance sheet, P&L account, and also I think Lalitji mentioned that there is other disclosure is there, other enclosure is there. So I think when you have to upload, the space should not be issue, and you can definitely include along with financial statements.
Yeah, and just to complete that, if in notes on accounts, supposing something important has been missed out, say this retirement benefits policy has not been mentioned, those things, then maybe the audit report will have to take care of it, that okay, this particular is non-compliance with a particular standard.
Yes.
Or
Fantastic,
typical fixed assets are not in many cases shown as gross block, net block, opening balance, addition, etc. They straight away start from WDV. So that is not in compliance with disclosure requirements as far as standard on earlier that fixed assets is concerned. So maybe that will need inviting attention of the readers. And also one thing one has to note is that one will have to appreciate that as far as possible to guide the assessee to follow the standards rather than avoiding following those standards. Thank you.
Yes, I think that's very important thing. First is notes on account should include maximum disclosure which is required by AS. If it is not there, we must refer in our auditor's report about non-compliance of thereof in our form 3C or 3CB in our auditor's report. Coming back to our discussions which is going on right now, in the accounting policy which is mentioned by the company, it mentions that stock of cards are valued at cost and on FIFO basis, and include all applicable overheads in bringing the inventories to the present location condition. Work in progress is valued at cost. I received response from Manishji. Can cost or FIFO both be applied? Fine. So let us now look at first requirement. See, basically, these all are the listing of the incorrect accounting policy. As per AS2 inventory concerned, first is the cost formula. Inventory is to be measured at cost or NRV, whichever is lower. Cost or net reserve value, whichever is lower, that is the measurement of inventory. Second thing, inventory is to be classified into raw material, work in progress, finished goods. And for each class of inventory, we need to have a separate measurement, separate thing to be disclosed in accounting policy. So if you talk about raw material and work in progress, if you don't mention finished goods, not correct. Every class of inventory which is reflected in my accounting in my financial statements, how they are measured, how they are done, that is to be shown and disclosed in accounting policy. Now, as Manishji asked question about can cost and FIFO, Manishji, basically how to measure, how to arrive at cost. For that, there is cost formula which is a FIFO or weighted average. So first is arriving at the cost. How to arrive at cost based on FIFO or weighted average, and then come measurement, which is the cost or NRV, which is lower. That is what is the whole concept of AS2 about inventories. And here basically you need to look at that everywhere there is issues on not covering complete sets of inventory, RM, WIP, FG. Certain cases we have seen that cost or NRV which is lower is not written. Certain cases it is loosely worded as FIFO or weighted average. That is not correct, and we have to be very sure as far as this is concerned. Coming to the next point is on basically inventories are stated at lower cost or NRV. Cost is determined on weighted average of first in first out basis. So that is not correct. You have to be specific. You can't say either FIFO or weighted average. One has to be very clear what has been done. So which kind of signal is provided to readers? Readers should be very clear that whether cost is measured based on FIFO or weighted average, you have to be specific So in case if you are doing FIFO for A or B, then you have to mention in that particular aspect not FIFO or weighted average as appropriate. That is not the loose word can be allowed under notes and accounts. Okay, next point is on AS3. I'm not taking all standards. My focus is not to cover standards, and my focus is to just provide you glimpses of the errors available. And these are only a snapshot. The best is the compendium issued by ICA on by FRB board, and where there are a lot of issues are there, a lot of errors are there. So you can deliberate, you can interact, you can go through these questions, and then we can learn from that errors as the time permits. So coming to AS5, that is prior period items. The accounting policy on prior period adjustments states as follows. Prior period expenses and income are included in the respective heads of expenses and income in the profit and loss account. That is not correct, because AS5 states that the prior period item nature and amount should be disclosed separately. You cannot say in respective head. Respective head means what? If for example, if there is some issues on advertising expenditure, I include advertising expenditures, but there is no mention that it is a prior period item. So the nature and the amount of that should be disclosed separately as far as AS5 is concerned. Coming to next point is on AS7. AS7 construction contracts is critical for all of us. Why? Because here the disclosure requirement is very, very harsh, which requires a little detail one. Then what is the percentage of completion method, then work in progress, how this measure valued. So this is what we need to be very sure when we talk about AS7. AS9, look at this requirement. Here it was disclosed that the revenue from online educational services is recognized upon receipt of subscription fees in case of non-refundable, otherwise apportioned over the subscription period. So in certain cases it was mentioned revenue from online educational services is recognized upon receipt for subscription fees. So that is not correct, because first and very important thing is that uh, revenue shall be recognized over the period when the services are rendered. Now, when you mention that I have recognized based on cash basis, not correct. So your matching principle is very critical. As you provide services, you incur a cost, and revenue thereof should be recognized in the same period, so you are able to match the cost and the revenue, and then profit is coming appropriately. Dividend income, the policy was mentioned that the dividend is accounted as earned received. That is not correct. Dividend income shall be recognized when the right to receive payment is established. There was in a significant amount was there in classification of fixed schedule, that is on site and land development during the year. However, no depreciation has been charged in respect thereof. So if you look at here, site and land development cost, which is part of my fixed asset schedule, amount was material, no depreciation was there. So what is incorrect? First thing is that you have to divide these into the class of assets. There may be an amount which is pertaining to the land, and there can be an amount which is pertaining to the building. So first you have to classify this amount into either for land or building. If it is for land, there is no need to worry about depreciation. If it is for a building, then in that case you have to provide depreciation as appropriate for a building. This is one of the very, very important point which I have seen in many cases, because the export of sales is a common across all entities, irrespective of the corporate or non-corporate things. And the accounting policy mentioned that the export sales have been recorded at the rate notified by the customs for invoice purposes. So I think that is what is being written here. This is not correct, because for the purpose of customs, the rates are separately identified. The objective of custom is different. The custom is primarily concerned with respect to revenue, and they also notify rate for certain days, 10 to 15 days, it may be the same. However, if you look at AS11, AS11 states that it should be recognized at the exchange rate as on the transaction date. So the date on which the transaction happens, on that date, what is the bank rate, what is the exchange rate, that exchange rate has to be taken for the purpose of computing and conversion. Next point, which is critical, is that the accounting policy mentioned that the current assets and liabilities at the end of the year are translated at exchange rate, ruling on the date of balance sheet. See, current assets is not a correct thing because AS11 use the word monetary asset and liability. So when the word is monetary asset and liability, then only it is correct. So you have to translate the closing exchange rate only in case of monetary items, not on non-monetary items. So current asset is not a technically correct word. That is wrong here. So coming to AS15 employee benefits, under AS15 employee benefits, there are many companies where we have seen that the disclosure which is required by AS15 of the table of assumptions, that they were not there. So that is not a compliance. Borrowing cost, again, we need to look at the qualifying assets. That is the very critical thing if you want to capitalize it. Segment reporting note is compulsory, even though if you believe the company has only one segment, the company as a whole is one segment, but still that disclosure required under your notes on accounts. Leases, even if you are having a lease, you are a lessee and you are having operating lease, under operating lease, so there's a need to disclose the requirements for future minimum lease payments to be classified to less than 1 year, 1 to 3 years, and more than 3 years. So even if you are having a lease rentals, there is a need to look at the compliance of this based on non-cancelable lease period. One very important point before I conclude and forward is on AS22 deferred tax. As I mentioned repeatedly earlier, that the deferred tax has been the cause of concern, but that is critical. That is very, very important, applicable for all of case. So we have to be very sure about the deferred tax which is appropriately connected. And second very important thing is that if it is the one entity, there cannot be DTL and DTA separately, because AS22 says that you have to offset DTA with the DTL when you have a reasonable, when you have when you right to offset and you intend to offset. When you are a part of one particular income tax act, you are filing one tax return, then obviously you can offset both the things. So you have to offset instead of showing both separately. Intangible assets, again, the question is on intangible assets, that basically preliminary expenditure, pre-incorporation expenditure, marketing expenditure, advertisement expenditure, they all cannot be capitalized and deferred, or there cannot be a deferred revenue expenditures. The concept of deferred revenue expenditure is no more there. So please ensure that it doesn't have this kind of things. AS21, 23, there are issues on that. I'm not delivering on that because in non-competitive which may not be very, very critically applicable. So in case of AS29 last standard, I'm just taking here guarantees given by a banker for performance. So performance guarantee is not a guarantee to be disclosed. It's only a financial guarantee that is to be disclosed as per AS29 is concerned. So with this, what I do before I come to the last slide, this slide is talking about learn, apply, achieve. The focus of this 2 hours session was primarily to give you a learning on one of the most important things, that is accounting standards for non-company entities. The topic itself was non-company, with the objective that generally it is perceived that the accounting standards are only for company entities, but that is not the situation. That's why to create awareness, the specific point was that it is for non-company. We have learned over the period, and the only request to each one of you that please apply something in your practice, one step ahead than what today. That is what I expect from each one of you. If that is done, then my time, Chitra sir's time, and everybody's time has been appropriately done. So with this, I am thankful to each one of you to be so much interactive during the session, and my special thanks to Pune branch for giving me invitations. And another very, very important thanks to Chitra sir. He is one of the most important person in this particular thing. Still, he's so much busy, but still he has spent some time. He has spent time with all of us, and he was there to provide his inputs. He has been continuously seeing that we all are being aware about the latest amendments which are being there. So Chitra sir, thank you so much for with me and sparing your valuable time. And now I hand over the charge to the organizer for their inputs.
Well, thank you, Chintan. I mean,
No,
by this,
I'll just
we, yeah, sorry,
yeah,
Chitra sir. Yeah,
yeah.
tell me.
So, actually, for last say a couple of weeks, I was thinking of reading all this material on standards applicable or other not applicable to MSMEs, because now we have to start audits and all those things, because there is an opening up. But then when branch scheduled this Chintan Patel's session on this particular subject, I thought that rather than reading, it is better to listen to him so that all doubts will be clear. And that is the reason that I participated in this particular meeting. And I'm really glad that Chintan has amplified everything which was necessary for the purpose of conducting audit during this particular season. And since he has pointed out that this was with specific reference to tax audit, let me also supplement a couple of points that in case of company audits particularly, which clause is applicable, and if supposing the turnover is say 50 crore, 100 crore, at times people say that for this company or a cooperative society or maybe even LLP, that it is clause A or B depending upon turnover. But then you will appreciate that the tax audit quality review board has observed that the audit is not conducted under that clause A or B. It is conducted under the third proviso to section 44 AB, which says that where your accounts are under audit under any other law for the time being in force, then it would be sufficient that if you enclose that report and give necessary forms. So please do not mention whenever there is audit otherwise applicable, like in case of cooperative society, company, limited liability partnership, charitable institutions, etc. So one will have to be rather careful. In case of stocks, he has rightly pointed out that generally I have seen when cases come for appeal, that it's stated that cost or market value, whichever is lower, that is the usual terminology which is used. And he has very rightly pointed out that market value is not available in the standards. It is the net realizable value. And again, as far as cost is concerned, you have to mention how the cost is ascertained, whether you have gone on FIFO basis, LIFO basis, how you have dealt with overheads, etc. So it needs amplification so that readers will understand how what policy you have followed. And Chintan, I compliment you for really inviting attention to this lacuna. Another thing maybe like fixed assets I mentioned, that the format is given for the purpose of disclosure is like gross block, depreciation, net block. And in gross block depreciation, again, we have balance at the beginning of the year on first day, etc. So that is generally not followed. So if it is not followed, maybe it will require mention. And last thing and very important is that as far as these preliminary expenses are concerned, incorporation expenses, as we are aware that they are allowed in 5 installments in income tax. So in number of cases, I have seen that if the expenditure preliminary expenses are 5 lakhs, maybe 1/5 is written off annually, and accordingly it is claimed in tax returns. So as far as taxation is concerned, there is no harm. As far as accounts are concerned, maybe proprietor, partner, if it is company, cooperative society, nobody is bothered. But then if somebody points out to the institute that this particular preliminary expenses are written off for 5 years, and then the case comes up whether you are guilty of negligence, I think it will go against you, because as you know, that it does not conform to the definition of assets that preliminary expenses you are carrying forward. So instantaneously they have to be written off, whether they are 5 lakh or 50 lakh rupees. Earlier, maybe few years ago, there was practice that, okay, deferred revenue expenses you are recognized. But now accounting standards have made it black or white. There is no gray area available. So either it is revenue expenditure or it is capital expenditure. There cannot be any deferred revenue expenditure, though we are used to this deferred revenue expenditure concept to some extent in your taxation, like preliminary expenses or discount on or premium on issue of debentures, etc. So I think all the points you have very nicely pointed out. So whatever I had decided earlier to read those books, I will not read. Thank you. And in case of doubt, I will once again see this particular presentation on YouTube.
Yes. Thank you. Thank you, Chitra sir. Thank you, Chintan. I mean, only we chartered accountants can save the world with peace. Then accounting standards is what I believe now, right? So, and it's such a mammoth job to simplify it, right? So, I mean, while hearing and I mean, throughout the process, it was so simple and it was so elaborative for all of us that it was such a feast Sunday morning, really, Chintan, to listen to you. And if we don't have any other questions, then probably, Chintan, do you want to share your email address or something so that people can get back to you if they have any questions or something? So,
उसका ID सारे दुनिया को पता है, फोन नंबर भी पता है.
right.
ठीक.
So on that note, thank you so much, Chitore sir, Chintan, Pune ICI, and all the dignitaries for arranging this wonderful session for all of us. And wish you a very good Sunday, and hope to see you all very soon. Thank you.
Thank you, sir.
Thanks.
Shyli, I
Good
thought
day.
you were in for lunch.
Yes.
I waited till then.
Once this pandemic gets
Yeah.
little better, then yes. Yeah. Thank you
Yes.
very much, everyone. Thank you.
Please,
Thank you for joining us. Thanks.
for doing this particular webinar. See you once again. Thank you, Chitra.
Thank you.
Thank you, sir.